to Looking at the Markets with David Modell. I want to talk about earnings plays with stocks and options. Do I recommend trying to predict what's going to happen with an earnings report? Well, let's take a look. One thing sometimes people do is they read articles or they listen to so-called experts or analysts. And well, let's take a look at Netflix. This guy predicted that he recommended short Netflix ahead of Trump. All right, and this was made before an earnings announcement by Netflix. And if you had followed his advice, let's see how you would have done. Well, after earnings, this is after hours, right after the Netflix earnings announcement. Let's look at the news. Netflix beats subscriber guidance, paints wider margin targets, and after hours it's up over 8%. Almost $11 up after hours. And so if you had listened to the analyst or the so-called expert, you probably would not be very happy right now. And so I do not recommend basing your decisions on so-called experts or analysts who try to predict what's going to happen with earnings announcements. I don't think that's a great way to try to base your decisions. All right. So how about looking at past earnings reports? Well, let's take a look at Netflix again. Let's see if we can look at this column right here. We can see the the next day after earnings. We can see the percent of change, and we can try to predict whether it might have gone up or down. And it's about half and half up and half down. Some big down days, some big up days, and some not so big up and down days. It's kind of random, really, and it's not dominated by up days or down days. And so I can't really form any conclusion or make any prediction based on past earnings reports. And I've looked at many other past earnings reports, and this is from busystock.com, by the way, where they show the past earnings reports. And I've looked at many of them from many companies and many stocks, and it's oftentimes or usually like this, where it's just pretty random. It's not dominated by earnings beats or earnings misses, and so I can't really form any conclusions from that. Well, how about you might say, okay, well, you know what? I'm not going to try to predict whether it's going to go up or down after earnings. What I'll do is I'll just buy a straddle. Okay, I'll just buy an at-the-money call option and an at-the-money put option. All right, and that way I don't have to predict the direction. I just have to. I just need a really big move, and one way or the other, up or down, and I'll make a nice profit. Well, look how expensive. This is right before earnings. Look how expensive the options are. A straddle would cost, the call would be over $6 a share, and the put would be over $6 a share, for a total of almost $12.50 a share. So you'd have to, it would have to move more than that just to break even. It would have to move that much just to break even, and more than that to make a profit. Yeah, almost $12.50 a share, and so far it's moved not even $11 per share. Okay, and that's a sizable move. So I don't think that buying, since they're so expensive, since the options market inflates the prices right before earnings announcements, I don't think it's a good risk reward to buy a straddle right before earnings. And you might be thinking that a strangle, which would be an out of the money call and an out of the money put, might cost less. Well, yeah, it probably will, but in many cases that would require the price to move even more. It would require an even greater move in the underlying stock, and so your probability of success would be even less, quite possibly. All right, and so what I don't recommend is trying to predict beforehand. Instead, what I do is I make my move after the earnings announcement. Okay, for example, if there's a big earnings miss on a company that I like a lot and that is consistently profitable, and it's a company that's well established and has been around a long time, and I'm confident that it will recover, then if there's an earnings miss and the stock goes down to my target price that I'm willing to buy it at, then I might buy the stock, or I might buy a call or a call spread. Okay, so I'm more into post-earnings plays rather than pre-earnings plays. So, and one more thing, I just wanted to show another example. This is from United Health Group, and just to show how irrational earnings season is, if you look at the news here, United Health Group's earnings jump 56% in the fourth quarter. You think that would be good news, but let's look at how the stock performed post-earnings. It's down, and if you look at the chart, bam, straight down. So, good news can be interpreted by the markets as bad and vice versa. It's not rational. I don't think it's predictable or tradable, okay? So that's just something to think about. Alright, so if you found this video helpful, please give it a thumbs up on YouTube and leave comments. And also please subscribe to my YouTube channel so you can receive the latest updates on my financial educational videos. And if you want some help with stocks, options, or finance in general, or if you want to put together a trading plan, because you really should have one, you can email me anytime at davidmodell@gmail.com. Thank you so much for watching and listening. I appreciate it, and I'll talk to you soon.